Right, I'm just going to talk you through Bella's bean bags, the ratio question, go through the data, which is hopefully going to help you answer the question. Okay, so what we've got here is a 12-mark question where we know that you've got to do similarities and differences, if you can find them, pros and cons, and give your conclusion. You're asked on this question to evaluate, using the ratios provided, the financial performance of Bella's bean bags compared to comfy chairs. Comfy chairs has been trading for 4 years. Bella's bean bags has only been trading for 1 year. So she wants to know how she's performing. Okay. So what you've got to demonstrate is your understanding of what these ratios mean and the impact to Bella's bean bags. And you could say with your conclusion who's performing better and why, and what she could do in the future to improve. So I'm just going to give you a bit of a whistle-stop tour of what they mean. So you've got your gross profit margins. So for every £1 earned in sales revenue, they're earning 36 pence back in gross profit here. So Bella's bean bags is only earning 25 pence back. You could say, when you're looking at similarities and differences, you could say, you know, the difference between percentage. If they're quite close, you could say that's a similarity. Or, for example, the net profit margin, 22 pence in every pound that they've made in revenue is coming back to the business. You know, they're not, both of them are not performing that well, okay, on that one. Inventory turnover, Bella's actually performing better. What this means is how many days your item is in your stock room, and you want it to be, you want to have a quick turnover, because it means you've got that steady cash flow coming in. If you've got stock on the shelves, that's cost you money, so it's sitting there, it's not doing anything for you, it's not being sold, not earning money. So she's performing better there. This one here, she's the trade receivable days is where she's basically asking her customers to pay her within 40 days, but she's paying out within 7 days. What you basically want, and as opposed to this company here, she's asking her customers to pay her back within 14 days, and she's paying her bills off in 60 days. So that means she's got a lot more money in her bank account. She's got money coming in from her customers, and she's not having to get rid of that and pay her bills until 60 days. So she's in a much better position in terms of cash flow. So that's not that good there. But this one is on the paper, it doesn't have the colon and the 1, which is a bit of a, it's not very nice on their part doing it, because what I understand from this is, and the way I do it, is for every £1 the business owes in liabilities, on the left hand side it's what they own in assets. So for every £1 that they owe, can their assets cover their short-term debts? Are they able to pay off their debts? So in this case, Bella's performing better. So for every £1 in liabilities, this comfy chair has only got 90p. So if they were trying to get some credit, a loan or a new supplier, the supplier might not think that they're a good risk, because they might not be able to pay, all right, because they've not got enough assets, they don't own enough to be able to pay it off. But she's performing better there. So you're looking at, what are the pros, what has she got that's better off, and what are the cons, what is she not performing as well in. And you could, in your conclusion, say which one you think is performing better and why. And you can also say how Bella could improve in the future. So for example, she could definitely improve this. Trade payable days, trade receivable days. How could she improve a gross and net profit margin? So the gross profit margin is to do with, you know, the sales price, linking with her suppliers, could she get a better deal? You know, that would improve that, and in turn it would improve that as well. But could she reduce her expenses? All right, so that's a bit of a brief tour. Just come over here with the video. So I would start it, I mean, some people like to start with what they've been asked to do. So you've been asked to evaluate the financial performance of Bella's beanbags compared to comfy chairs. You could just say that, get you in the zone. And then you're looking at similarities and differences, and from other students, they sort of say, well, there's not that many similarities. Well, you could say, you know, the profit margin's not performing that well. And just give me some figures. How different are they? What's the percentage difference in the days and all that sort of thing? Is that close to what the other company's doing or not? Try and do any calculations you can. So what is the difference in numbers? Pros and cons, what knowledge can you bring in? So like I was explaining back in that video, that's the sort of thing you've got to bring in, the impact to each company of the performance. And then you've got to make sure you've got that conclusion. Which one do you think is performing better? What could she do in the future? All right, thank you.
Good.